So we saw a rally on Wall Street yesterday, tech stocks especially rebounding after the NASDAQ 6-day slide. After that, slightly, and I want to emphasize it was very slightly cooler than expected core CPI report. A lot of people thought that was because it left the door open for Fed rate cuts. But you think we saw a rally because people before thought the Fed wasn't hawkish enough. You have to explain that because I haven't heard anybody else say that.
Well, the thing is, as we saw last rate cut, we had more Fed hawkish tone, right? And so the idea being, if we were talking a few months ago, we would have been certain that we would see rate cuts this year, at least 3 or 4, actually. That number came down. That's why we saw the volatility earlier. So I think in this case, it's just about the Fed not being hawkish or being more accommodating than we thought that they were going to be. So we are in the camp of we will see a couple of rate cuts this year, most likely. But, again, a few months ago, we would have thought that they were going to have more cuts.
Okay, so you thought they were going to have more cuts before. Why don't we move on and look at those moves in the Mag 7? We've seen tech under quite a bit of pressure to start the year. We just mentioned the NASDAQ was on a multi-day slide before yesterday. Now with this rebound, how are you viewing the tech sector? A lot of people were like, buy the dip, buy the dip. And many people did, but that still doesn't alleviate some of the concerns about valuation and also over-concentration when we look at the markets.
It's true. That's absolutely right. These stocks are expensive, and there's concentration in the S&P for sure. At the same time, given this year, we do think there's a wider potential array of outcomes given the new administration, given what the Fed is going to do, given a number of different factors. These names have solid earnings. We expect those to continue. ROEs 30%. So we expect these companies to continue delivering on their free cash flow and having positive earnings for us. So yes, they're expensive. And if anything goes wrong, the more expensive stocks, of course, we can see more of a pullback, but we are positive in tech and do think these companies are going to continue delivering, and that AI demand will be there, which will continue to drive some of what we're seeing. So we're positive on large cap tech, mega cap tech.
Positive on large cap tech. I want to ask you about some of the other sectors right now, some that are actually in correction. I'm looking at healthcare, S&P materials, real estate, all of them pulling back more than 10% from their recent highs. We've seen energy actually be the best performing sector this year, big rebound from last year. Of these 3 sectors, do you see the potential for a rebound as we go through the rest of the year? Healthcare, of course, the defensive sector, but materials is a cyclical, real estate very rate sensitive. So 3 very different stories here.
Right. It's true. I mean, there's potential, and especially with energy, I think we have an administration that is going to be, we're going to be hearing more talk, deregulation especially, but I do think with energy, you're going to see a recovery there. And frankly, if things go well, if earnings are, we're going through earnings season now, right? If we continue to get those positive earnings results, I think we'll see more of a recovery in these sectors. But something like real estate, for example, that's going to be interest rate sensitive. So we're going to see how things play out with the Fed.
All right. You have a pick for us today. It's Goldman Sachs. Obviously, financials reporting their earnings this week. What is it about Goldman Sachs that you like? We got, obviously, a read on how they see the year ahead after earnings. One of the things I thought was really interesting is that they said they see an uptick in sponsor activity, and you also noted they're the #1 M&A shop.
That's exactly right. So we like Goldman for a few different reasons. We like the financial sector more broadly. I think the rate environment is going to be favorable for them, but they are going to be a beneficiary of this deregulation that we've been talking about and seeing signs of once the new administration comes in, and they're pro-growth. So in a pro-growth deregulation environment, pro-business environment, this is the best kind of environment for them. So that strong M&A that we saw and showed up in their earnings, I think we see more of that, and they're in the best position. They've retained their #1 M&A advisory position, and I think they're the best, the leader in this category.